The Rebel Capitalist Show.
All right, guys, it gives me a great deal of pleasure to welcome someone to the Rebel Capitalist Show that I've really looked forward to speaking with. He's a rock star on FinTwit. He's great buddies with my good buddy, Patrick Ceresna. Everyone knows him from Macro Voices, and he's been recommended to me recently by everyone, especially Lynn Alden. She says, George, you gotta talk to Kevin right now. He's got some incredible insights for your audience. So Kevin Muir, welcome to the Rebel Capitalist Show.
Well, thanks for having me on. I'm worried I'm not going to live up to that huge intro.
Yeah, well, I think you'll have no problem with that. But for my audience who doesn't know your backstory, can you fill us in on that?
Yeah, sure. So I was originally an institutional equity derivatives trader at a big bank in the 90s. And our first daughter was born with a heart defect. And so I was in 2000, I was a young Turk. I was still 29 years old. And I kind of had one of those awakening moments where I decided what's important in life and decided that I had enough of working for the bank. And I took off and quit the bank and decided I was going to go start trading my own money. And me and another guy did that. And we went about that for almost 20 years. We did that. And one day my daughter went off to university and I said, I better go get a real job now. And so since then I've been doing a little bit of things with, I write the Macro Tourist letter. That was part of the reason I did that was I was basically just in a room alone and desperate for some people to talk to. And it was a great kind of tool for connecting with people. And I've had a lot of fun and met people like yourself by doing that.
Yeah. So tell me how that was starting out your investment career. You said in 2000.
I worked at the bank from 93 or 94 to 2000. So I was an institutional equity derivatives trader. One of the things is I worked for Royal Bank in Canada, and they're kind of like the Goldman Sachs of Canada. And it was a great time. It was a great place to be. They were very entrepreneurial. They didn't care if, I always used to laugh and said, it didn't matter if you were a man, woman, or what nationality you were, or even if you were from Mars. If they thought you could make money, they would let you go and run with it. And it was a terrific place. There was some very famous people that I got to learn from in terms of trading. And so I did that for the kind of the 90s, in the dot-com bubble and the long-term capital. I was actually in charge of risk for the Canadian equity derivative book, and I learned a lot from that. Mm-hmm. And then in 2000, I went off and did it myself. And one of the things was that at the bank when I was there, when I first joined, it was actually more of a securities dealer, meaning that it was like an old partnership and it was run by the employees. Gradually, as time went by and the banks became more involved, it became more bureaucracy, and instead of that same entrepreneurial spirit, it was more like you can't trade that, and I got in trouble for trading this, got in trouble for trading that. And so it was nice to go off on my own and no longer have someone getting mad at me because I was trading JGBs or some other spread that I wanted to do. And it was liberating, but at the same time a little bit scary.
Yeah, that makes a lot of sense. So help me understand what it was like to be in the investment game or the trading game back in the dot-com bubble. And then what similarities do you see today, if any?
Oh, I think that this is almost exactly like the dot-com bubble. I've been comparing this current environment to the dot-com bubble for a while now. And I just see the things like Dave Portnoy and all this retail participation. And to me, it just seems like we're reliving it. And, I kind of, when I think about the similarities between now and then, I kind of believe that people should go and spend some time researching that period. I wrote a piece the other day about the fact that from 98 to 2000, there was 7 corrections in the NASDAQ that were between 10 and 15%.
Oh, wow.
And I said, so I said, like, stop and think about that. That's actually, and all those corrections were 2 weeks in 2 weeks or less. Mm-hmm. And that's one of the things that when everyone was getting bearish, a week ago or so, I said, be careful out there, because the reality is that if we are in one of these kind of manias, we can expect to see these 10 to 15% corrections that occur. And then all of a sudden, boom, we just keep going again. The NASDAQ went, and it just to keep it in perspective, the NASDAQ went in off of the long-term capital bubble. We had the crash, it doubled. And then, and that happened in 6 months or something. And then it proceeded to double again, in the next year. And so when everyone's sitting here and staring at the NASDAQ today and saying, oh, look at this thing, it's up 100% from the lows, I'm saying, remember back to 99 where it doubled again from this period. And I'm not saying for sure that's going to happen. I'm just counseling people that are so certain that it's going to collapse. I'm saying, go look at history, because there's other times when it didn't, and it actually caused a lot of pain for the bears out there.
Yeah, I've been investing since 2012. That's when I retired as an entrepreneur. And prior to that, I knew nothing. I mean, I didn't know what an interest rate was. I didn't know what the Fed was, just zero. And I think one thing that stuck with me over the last 8 years of getting involved with this and really just kind of obsessing over it, it just seems that the market maximum amount of people possible. And when you're sitting there talking about how it takes a 15% dip and goes up 50, it's like the market is training all of the retail investors to buy the dip. It's the same thing you hear today nonstop. And once everyone has kind of been programmed to buy the dip, that very last time when it dips down 15, everyone else buys, and then it goes down 50, 60% and just wipes everybody out.
For sure. But the unfortunate thing is, in the meantime, there's a lot of bears that are going and every time it dips 15%, selling, going, this is it. This is the start of the end.
Yeah.
And it just keeps hurting people. And I remember that in 2000 or 99, how many of my colleagues were so bearish all the way up. And eventually they proved correct. But that famous line by Keynes in terms of, the markets can remain irrational longer than you can remain solvent, has never been more applicable than it is today.
Yeah. Okay. So on that note, what are your ideas for today? We'll just start with the stock market, the bond market, the dollar, and gold. And also 2020, maybe kind of do like a past, present, and future just for this year.
Well, okay. So one of the things that I'd just like to step back and think about is that a lot of FinTwit and a lot of hedge funds and a lot of smart people are obsessed with this idea that debt is going to cause an implosion and we're going to get a real collapse. Mm-hmm. And for a long time, I've been pushing back up against this, because if we think about debt, I completely agree that debt on the corporate balance sheet or on the consumer balance sheet or even the state or the provincial balance sheets, those debts are real, and those are they have the ability to actually cause an implosion. But one of the things that people have been missing, and this is something that I've been trying to stress, is the fact that debt on a sovereign balance sheet is much different. There's a huge difference between a currency issuer and a currency user. And once you kind of come to terms with that, and you might not like that, because you might say, oh no, that's not how debt works, and eventually it's going to cause inflation. And every bone in your body might kind of repulse and want to jump out of your skin when you hear MMT, which is the people who believe and have kind of espoused these theories. But the reality is that the COVID situation has been a perfect example of how much power the government has to actually reflate the economy. And once you start thinking about the world in a little different manner and realizing that the government has the ability to kind of create money into existence, a lot of the other ideas that seem so prevalent in terms of, oh, this is going to end in a collapse, the stock market's going to go down, you'll realize that that's probably not what's going to happen. And in fact, I believe that there's more chance that this ends in a kind of incendiary melt up, as opposed to a kind of a deflationary collapse. And all we have to do is kind of look at these deficits that the government is running. And the reality is that they're prepared to spend whatever it takes. And if they're going to do that, then you have to go and change a lot of what you've kind of used as your rules in place for the past 20, 30, 40 years, and realize that the world has changed, and set up your portfolio in a much different way. So since the Volcker kind of 1979 and this the triumph of monetarism on the economy and the financial system, basically market participants have focused on that, and they've been that's the only thing that they think that can be done. Monetarism. And all you have to do is look at Europe. to see, how they continue to try to use more and more negative rates because they're just unable to kind of get around the idea that there's any other way to do it. Well, I've argued that Trump is actually the most MMT president that we've ever had.
Oh,
and what do I mean by that? Well, MMTers, they argue that there is no financial constraint on a sovereign that issues its own currency, meaning that a government can continue to spend as long as they, they're not limited by the amount that they can spend. The real constraint is actually a real constraint, meaning that it's inflation is the constraint, because eventually when they continue to spend, they will create inflation. So let's go back to Trump and why he's the most MMT president we've ever had. We were 8 years into an economic expansion. The Keynesians would be telling you that you should be balancing the budget. The Austrians would be telling you should be raising rates because, this is all. Meanwhile, what is Trump doing? He's going and he's lowering taxes and he's trying to lower interest rates. They ask him, why, if the economy is so good, do you want to do these things? And he said it's because there's no inflation. And what's happened is there has been a wholesale change. He was the start of it. But I would say that COVID has ushered in the realization that we are not financially constrained like we thought. And again, you could I know that makes a lot of people upset and they all go, that's going to end badly. And I go, fine, maybe it ends badly, but the reality is this is the way we're headed. And if this is the way we're headed, I'd rather set my portfolio up to take advantage of it than sit around and kind of bemoaning all the people who believe that this just shouldn't be. Don't trade what should be, trade what will be. And in that argument, I believe that inflation is the big problem coming forward in the next year and even decade.
Okay, so yeah, that makes a lot of sense. The one, I've got a couple issues with the MMT folks, but the one thing that I find fascinating is that they think that that's revolutionary. And I'm like, that you're not constrained, or the government isn't constrained by how much money they can create or how much they can spend, let's say, but they're constrained by inflation. And I think that's pretty much, yeah.
Well,
you got it. You're right on. Exactly.
Yeah.
Exactly.
Well, but I think a lot of people would argue that the government can't create inflation, and the MMTers would argue that you can, and you will. And I do believe that a lot of their policies are much different than what we've been doing in the past. Because if we look at it, we've been relying on monetarism, and we've been relying on private sector credit creation to create all dollars. And that's like, go look at, ever since the dot-com bubble crash, we've met every single recession with lower and lower interest rates. And so at that point, the great financial crisis came along, and we realized that monetarism was no longer going to work and that the private sector cannot create any more dollars. And now finally, in terms of the COVID, we've kind of hit a point where the governments realize that they can spend it into creation. And yes, you're right, MMT is as old as the hills. Because the reality is that, way back when the Adam Smith talked about this, but the reality is that most economists don't believe MMT and are still stuck on the idea that monetarism is the only way to create dollars.
Oh yeah, I see what you're saying. Yeah, I was just talking about the simple logic that the government can spend money and they don't have to worry about finding it because they're a currency issuer. But the constraint is inflation there, and I think a lot of but then you transfer that over to their policies, and I think they would assume that there's so much excess capacity in the current economy that we're not spending enough, or we're not creating enough currency units. One thing I'd like to get your opinion on, going back to the MMT, and that I kind of struggle with, because I totally understand what they're saying, and I've listened to several interviews with Kelton and Mosler, and then just gone back and forth, and it makes a lot of sense. Their description of how the monetary system works, or the kind of the plumbing, I think, is very accurate. But I just kind of have some contentions with their policy prescriptions. But with the government spending money into existence, how do they account for the TGA?
Well, the government. So one of the things is a lot of people believe that the central bank cannot have a negative equity. And if you go look at the Israeli central bank, they run a negative equity. There's no reason why. Yeah. And the other thing is the government goes and they spend money and then they borrow. And the reality is that borrowing is purely self-imposed constraint. there's nothing stopping them from actually just spending the money.
Right. But
like apart from our laws, but those are self-imposed laws as opposed to economic laws. And that's where they really differ. And at which point you go, well, wait, if they're just spending money into existence, that's going to create inflation. Completely agree. Eventually it will create inflation. The whole question is, how much do you want to do? Like, what is the proper amount of spending that money into existence? I must give you credit because you actually are much more knowledgeable and understanding and accepting of MMT. And I completely agree with you about the plumbing, them understanding how the plumbing works.
Yeah.
And let me tell you my story of how I got into MMT.
Yeah.
So I was, I'd watched it on FinTwit and I'd seen these guys talking about MMT and I knew what it stood for, but I didn't really understand it. So George Perks from Bespoke Investments, he invited me on to his podcast.
Mm.
And he said, what do you want to talk about? And I said, well, you know what, let's talk about this MMT because you seem to know more about it than me, and we'll just have a back and forth, kind of like you and I chatting today. Well, we went back and forth. It was more him talking than I because I didn't really understand it that well at the time. And it ended up being, he kind of phoned me up a couple of weeks later. He says, Kev, you're the third highest ranked podcast that we've ever had after, Jeff Gunlack and Patrick O'Shaughnessy or something, like real bigwigs, right?
Yeah.
And I kind of laughed and I go, well, it's obviously nothing to do about me. It's actually about MMT. So I realized right then and there that there was a huge desire to understand and do it. So I immersed myself in it. And as I'm an economics major, and if you had told me a few years back that I would go and be watching economics professors lecture, and I would have told you you're insane. Right. Because economists have just cost me money over the years, and I think they're absolutely useless. They're when they sit there with their formulas, I think they're pie in the sky. I think they're terrible. But then when I went and watched the MMT people, and I watched the lectures, and I got them they explain how the plumbing works, I realized that I was like, this is actually explaining how things are. And one of the things that I would encourage a lot of people that are, revulsed by MMT and they say this is just an excuse for the government to spend more. If you actually go look at the theory behind MMT, they would argue that that doesn't mean that the political choice to spend more is just that, a political choice. It's not actually part of MMT. MMT only just says that you should stimulate fiscally. That stimulate fiscally could actually be cutting taxes. And one of the things that when you go listen to Warren Mosler, who's actually the father of MMT and who's a bond trader by birth or not birth, but by kind of design. And he's actually very entrepreneurial and very right wing. You'll see that he's not always saying, we should go do all this green spending. He says, well, then cut taxes. And that's why, in some ways, I argue that the Trump is actually an MMT president, and it seems to make a lot of sense. Like, let's just take Europe, for example. I always use Europe because it's an example of trying to use old theories that aren't working. And so they keep lowering rates, trying to get people to borrow. I always said, like, if I was in charge of Europe, if I was a benevolent dictator of Europe, I would go and I would raise rates to 100 basis points, and I would cut taxes, and I would spend until the economy stabilized. Because, like, let's just stop and think about trying to get the economy to go by having more and more negative rates. If you're a European company and you're sitting there and you're thinking about whether you should make a new plant, whether you should do some Capex, does it make any sense, to go and create a plant because rates are negative? Like, you might say, well, you're getting paid to spend that money. Well, the reality is that if you go and you create a plant and there's no one there to buy your product, then the loss on your plant means way more than the cost of capital. So it doesn't matter if you're getting paid that 1%. If the plant is useless because nobody's there to buy your product, that risk is actually much more important. So if you go look at history, like Goldman Sachs has this great report that I love to talk about, and he talks about they go through Capex spending over the past few decades. And in the 80s and 90s, Capex spending was negatively correlated with interest rates, meaning as the interest rates came down, Capex spending went up. Well, in the 90s and 2000s and 2010s, the trend actually reversed
Mm.
to the point where Capex is positively correlated with interest rates, meaning as interest rates go down, people spend less on plants and equipment because they're more worried about the actual economy. So, a lot of people push back about MMT and say this is crazy. Why I say what's even crazier is trying to, stimulate the economy through more and more negative rates. And at its worst, you get that Rogoff with his, digital currency and wants to make rates -5%,
Right,
which
right.
I think is just absurd and is just a bastardization of this. And I think that those are the kind of policies that have gotten us in this trouble. And when I kind of go back, bringing this back to what do you do as an investor, I believe that has finally been pushed aside because of COVID, and now we have entered the new MMT or fiscal spending, whatever you want to call it, but finally an environment when they're going to be able to create inflation. And ironically, it's happened at a time when people are the least convinced that they will be able to create that inflation.
Yeah, so a couple things there. Going back to your Europe example, and just this hypothetical,
Yeah.
how much do you think, or actually going back even prior when you're talking about the inverse relationship between capex spending and interest rates, going back to the 80s and 90s, and then how that kind of made a fundamental shift in the early 2000s. How much of that do you think is due to regulation? Because I was an entrepreneur for several years, over a decade, retiring in 2012. And that was a big thing for me. If I was going to spend, not that I ever did, but if I was going to spend $1 billion on setting up a plant, as an example, and I know that I'm not going to be able to move that plant, then if I look at the regulatory environment coming down the pipeline over the next 5 years, and I'm like, I don't think this is looking good. I think I'm going to see an increase in taxes. I think that the government's going to be very unfriendly to capital and to entrepreneurs. I don't think I'm going to spend that $1 billion on setting up this factory. Or maybe going back to the 1980s, the political narrative was much more pro-business. And I think, okay, they're going to reduce regulations. Yeah, let's go ahead and spend that $1 billion. What do you think about that?
Well, I don't disagree that will be one of the factors. But regardless of the regulations, if you don't think you have someone to sell it to, if the people actually don't have enough money, it's not going to matter. So is regulation a factor? For sure. Is it the driving factor? I disagree there. I think it has more to do with the fact that there's no end demand, because the reality is that they're not creating enough dollars, or in those cases, euros.
Yeah, and what do you think about the concept? I've heard Dr. Lacey Hunt talk about this several times, because you kind of hear the whole money printing argument, and then you're like, well, the government could just continue to do this and fill up the excess capacity in the economy, as an example. But his argument, and I don't want to put words in his mouth, but from what I gather, is that the problem is really the government spending in itself and the way it distorts the economy and misallocates resources. So if you have the government at, let's say, 50% GDP, and then you are somehow able to take the debt, the sovereign debt, down to, let's say, zero, that wouldn't help that much, because the real problem is that government spending is 50% of GDP.
Well,
the private sector just shrank and shrank and shrank and shrank, while the government sector that doesn't produce any goods and services has just increased.
So there's no doubt that there's a philosophical argument about there, and that's why, going back to MMT and its roots, maybe you tax less then. If you believe that, then isn't it a function of the government's taxing too much because they're taxing too many dollars out of the hands of private citizens?
Yeah, right.
So those things. I'm not. There's always elements of truth in most arguments, right? Like it's just one of the things that bothers me about FinTwit and about finance in general is that there's always this all or nothing. It's either all this way or all that way, and it's just kind of like, what about just trying to find a happy medium and go down the middle?
It's always black or white. In reality, there's always these various shades of gray. I always I kind of get that feeling whenever I see people talk about inflation and deflation. And in my videos and everything, I just try to say till I'm blue in the face that, listen, this is a nuanced argument. You can have asset prices, as an example, come down while the prices at the grocery store are going up. It doesn't happen all in unison,
Yeah.
But it's very hard for people to understand that. And then you can have the consumer prices going up while the dollar is going up in the DXY relative to the euro.
Right.
And it's
Back
just
to your
a
thing,
lot of moving parts there.
it's meant to confuse the most people, right? And like that's for sure. That I completely agree. And you just have to look at the current environment. We've done stuff that people would have never imagined in a million years. Like very few people were bullish on lumber to the extent it did. And lumber's exploded. It's tripled or something from the low. Even the stock market. Let's look at the stock market. I was bullish, and I ended up being way too conservative. I who thought the government could spend and create a lot of dollars and wasn't as worried about the deflationary collapse. Even I've been surprised about how strong and how much they can create it. And I think that just kind of goes back to this fundamental misunderstanding about how money works. And people really think that there's a deflationary kind of inevitability. And I almost argue that there's an inflationary inevitability. I go look at history and I say, I don't know many countries that have collapsed because of deflation, but I sure know a lot that have collapsed because of inflation. So I think it's funny that everyone's assuming that this is all going to end in a deflationary implosion, whereas I think there's a much greater chance that it'll end in an inflationary explosion.
Yeah, that's a good point. And then going back to MMT, if I'm not mistaken, their policy, if inflation did run a little too hot or a lot too hot, would be to increase taxes. So you're pulling more liquidity out of the system. But my concern there is if you had a stagflationary type of environment where you have maybe flat or negative real GDP, and you have to increase taxes because of stagflation, that's going to crush the economy even more, isn't it?
Yeah, I completely agree. And listen, I'm sympathetic. I love MMT in terms of explaining how the economy works. I do think that there's a lot of policies that make a lot of sense. Having said that, I'm not by any means a pure MMT or like they want to get rid of interest rates. They would just get rid of the bond market. I think that's insane. To me, the bond market gives you perfect kind of signals about inflation. So to me, that'd be the last thing I would do, even though I understand their arguments of why it's not needed. I would continue to have a bond market so that I could get inflation signals. I think that they rely too much relying only on the private sector credit creation to now when they talk about it, they seem to forget about private sector credit creation and they focus solely on the government side of it. And that bothers me just as much. Again, it's one of these things. It doesn't have to be all MMT or all monetarism. The reality is it's probably going to be a blend of both. We've kind of abused monetarism and someone tells me we haven't abused it. All I had to do is point them to Europe with negative, 75 basis points. Or Japan. And I say, we've abused monetarism, and chances are we're going to make a mess of MMT as well. And I'm not here telling you that this is going to solve all the world's problems. I'm here telling you this is the way I see our society headed. And this is therefore why I think you should be setting up to be, don't own any bonds. And if you're going to own bonds, you own tips, which is inflation protected securities. You need some gold, and chances are the stocks aren't going to implode like you think they are, and just all these things. Now, and one of the things is, it's not like this is a religion to me. If I saw the deficit hawks coming in and winning the argument, I would change my tune. Like like if I saw tomorrow that we were going to go and start trying to balance budgets, I would be telling you to own all the bonds in the world. Because I'd be confident we'd have deflation or disinflation at the very least, and we would be driving ourselves into a European situation where we're going to have negative 50 basis points in a 10-year boon. That's what we're going to have. But I look around and that's not what I see happening. In fact, I see them kind of the two parties fighting to spend more. I see, countries all over the world running deficits, and I think the politicians have got a taste of it, and I suspect that they're going to continue down this road.
Do you think the individuals at the Fed or in the government looked or have or are looking at Japan and Europe and scratching their heads and saying, okay, well, they tried to create inflation and they didn't. What did they do wrong? And do you think that they figured that out, and therefore that's why Powell is always just pounding the table that we need more fiscal spending if their objective is to create inflation, to lower the debt burden on the federal government?
So I agree with your analysis about Powell. I think Powell has figured it out, and that's why he continues to say, listen, I cannot stimulate. And one of the things that I truly believe that Powell has done a good job in telling people that message, because if we try to rely on Powell by relying on monetarism to solve the stimulus, we're going to just make everything worse. And Powell's, doing what Bernanke tried to do, but Bernanke was not kind of successful in convincing the governments to spend. And one of the things that I would like to actually highlight is the fact that if you go look at the federal government, the discretionary spending year over year over the last 5 decades, actually maybe even longer, you'll see that there was only, prior to the great financial crisis, there was only 3 years when that spending went down year over year. They were 64, 68, so it was Kennedy and Johnson, I believe, and then 96 with Clinton. So only 3 years when the government spent less on a discretionary basis. Now, put aside all of the automatic stabilizers like pensions and unemployment and stuff like that. Just put those aside, because you can't control that as a government. All you can control is your discretionary spending. So for 3 years, they actually had declines. Every other year was up. Well, the great financial crisis hits. What happens is that the private sector has borrowed way too much and then stopped borrowing. And what does the government do? The government should be providing counter-cyclical spending, but instead goes through 5 years of negative discretionary spending kind of changes, which means for 5 years in a row under Obama, discretionary spending went down. And so people were like, why did we have such a bad kind of recovery coming out of 2008? It was because the private sector wasn't spending. And not only that, the government wasn't spending either. Yes, they were continuing to keep people afloat in terms of, unemployment insurance and stuff, but they weren't providing the stimulus that was needed. Now, contrast that to today. It is much different. And the question you asked is, does Powell understand, or does the Fed understand it? I think Powell understands it. Every now and then I hear one of these governors, these Fed governors, say some pretty stupid stuff, and I think that guy doesn't get it. But I do think that on the whole, the board does understand and does get it. And it's been actually remarkable to me, because Powell a year ago was actually not in this camp at all. And he was arguing that the book should be balanced. And he was actually, I would almost argue, he was a deficit hawk. And he's completely done a complete reverse 180. And I guess there's that old line: there's no atheists in foxholes, and there's no monetarists in after COVID. Is I guess the reality.
Or there's no deficit hawks. Yeah.
Yeah.
So yeah, with the monetarist approach, that they're just going to keep doing the same thing over and over and over and over again and expect different results just because those are the models that they've been trained with. And I would argue that it's like a cognitive dissonance type thing. If all your models are incorrect, that means your whole life work has been kind of just a waste of time. But let's say that they take charge of the narrative at the Fed, or the political narrative again. Do you think that takes us to this Banking for All Act, where we all have maybe accounts with the Fed, so they don't have to worry about the commercial banking system to increase the M2 money supply, that they can just take their bank reserves, increase the amount of bank reserves, put them directly into the accounts, and then that turns into and that's how they kind of circumnavigate the banking system to inject money to create that inflation that they think they actually need to facilitate real economic growth. Do you see them going that path, or what are your thoughts there?
Well, so I guess maybe explain to me what you're arguing, that the Federal Reserve is going to go and put money into each one of our bank accounts?
Basically, that I think the Banking for All Act that they're proposing is something to the effect that we all have accounts, just like primary dealer banks. We all have accounts with the Fed, so it's on their balance sheet. So they can create almost infinite bank reserves, especially if they can have negative equity. I didn't really even think about that, but if they can have negative equity, then they can really they don't even really need to have assets to buy.
One of the things that I think people often miss is the fact that yes, they can theoretically have negative equity, but currently under the existing laws, the Federal Reserve cannot grant; they can only lend. So we would actually have to. That would be a Treasury issue as opposed to a Fed issue, because there's no way for the Fed to do anything except lend. And they can only lend if they're certain it's going to come back, which is why in the credit facility that when they went out and bought junk bonds or corporate bonds, they were forced to actually have the Treasury assume the first loss because they needed to have certainty that they were going to get the money back. So often people kind of conflate the two ideas about the Fed and the Treasury, and the Federal Reserve cannot do that. Now they can do it on the behest of Treasury, and you could just go out and create it and they stick it into our accounts. But that would, again, have to come from Treasury. The Federal Reserve can only lend. Now, whether they should figure out a way to lend to the individual, yes, we could change the laws. But under the current, way it works, that wouldn't be, it wouldn't be feasible. And, I got asked the other day if I thought that the Federal Reserve was eventually going to buy stocks. I think, again, this is an example of people taking things too far, assuming that this is going to be, this is the logical end result and stuff like that. I don't think that's going to happen. The Federal Reserve is stuck with old tools. And your original question was whether the monetarists come back and they try to fix the economy.
Just let me preface, Kevin, by saying that the reason I think they might do that in their minds is so they can easily facilitate negative interest rates and just take it way negative, like -5 or something like that.
Well, I think that they have to get rid of cash.
Well, that's kind of part of the process. We all have these accounts with the Fed, call them primary dealer accounts. Then we all have an app on our phone where they put those bank reserves in there, however they do it. And then that's how you can spend this, we'll call them Fed coins or something. And then they ban cash. No one wants to use cash. And then there's no cash in the system. And they can increase velocity by saying you have to spend these Fed coins within a certain time frame. And then,
I think that is the stupidest, dumbest idea around. Honestly, I just don't think it's gonna work. It just doesn't cause you to go out and spend your money. Like the idea that they're trying to do negative rates to force you to spend money is beyond me. Like why don't you just go back to your idea that you said, work on regulation, work on creating a stable environment and make some inflation, but you don't need to go and continually use old tools. And I think that I sure hope that we're wrong and that we don't go back to those things, because I just think it doesn't work. And I think Europe and Japan are perfect examples of how relying on monetarism and extreme monetarism just is not the answer.
Yeah, I totally agree with you there. I don't think that's the answer. I just think that if they decided that was the answer, that might be a way that they kind of they facilitate it.
I don't doubt it. I every time I see Rogoff on TV with his negative, banning cash and stuff like that, I just shake my head. Because they're just, as you say, like to a carpenter that has a hammer, everything's a nail, right? And that's to me what it feels like. That instead of going and looking at how the system actually operates and realize that it's very simple, the government can just create more money, whether that be it taxing less or spending more. I don't care, but that's the reality, and we've kind of ignored this whole way that the money gets created, and we've just focused on only one side of it. And eventually I've said it before, eventually they're going to abuse it. Eventually they're going to make too much, and that is going to be a problem. But I really don't see us headed that way. I really think that when I hear guys on FinTwit talking about negative rates, and I hear guys go focusing on these extreme solutions, I think to myself, it reminds me of 1979 when Volcker came in and raised rates, and there was a whole bunch of really smart people who thought that inflation was inevitable and there was no way you could control it. There was one guy that worked for Salomon Brothers, is Henry Kaufman. He was known as Dr. Doom. And he went for the next 2 decades just talking about how inflation was going to resume and this was the end of the world, and he hated bonds and they were always so negative. And the reality was in 1979 there was a wholesale change in attitude. Real rates were high, and the government understood that with real rates they can actually slow down inflation and control it. Well, I think that this is now going to occur in reverse, and there's going to be a Kaufman and Dr. Doom of this environment who will be talking about negative rates as we go the next way for the next kind of 2 decades.
Yeah, yeah. And I had a conversation with Lynn the other day, and I think you've made this point as well, that the from a monetary standpoint, it's easier for the central bank to stomp out inflation than it is to create inflation.
Right.
Totally different ballgame.
Well, listen, I actually think it's impossible for the monetary central bank to create inflation in this environment. And let's just go through this, because I think this is actually an important thing for people to understand.
Yeah.
Let's go through quantitative easing, and let's think about the steps that occur. Let's do the plumbing kind of transaction. So the Federal Reserve goes and they tender for, let's just say, the January 5s of 2046, and so they buy 300 million, and JP Morgan sells them that. Okay, so the Federal Reserve goes, they buy the bond, and they credit JP Morgan with 300 million bucks. Now the kind of monetarists will say, well, now that money's out into the system, it's going to go get lent, and it's going to create inflation. Well, that's not what the MMT people believe, because the MMT people realize that the JP Morgan is not any more likely to make a loan just because they sold those bonds on their balance sheet, right? The reality is that JP Morgan was never reserve constrained for making the loans. They never decided how many loans they were going to make based upon the cash on their balance sheet. They made it based upon demand, like who could they lend to that made sense from a business perspective, and then they looked at it versus their equity and their balance sheet themselves, meaning like their capitalization. So when the Federal Reserve goes and buys bonds from JP Morgan, it doesn't change the amount of money that is going to be lent out into the system. Right. So what happens is JP Morgan just takes that money and puts it back on deposit at the Federal Reserve. So if you go look, what's happened is that as the central bank has done quantitative easing, interest on excess reserves at the Fed has exploded higher. Now, people will talk about velocity and go, well, velocity is collapsing and this is why and stuff. Well, the reality is that velocity is almost a plug-in number after the fact, where you look at how much, dollars outstanding versus the GDP and you figure out the velocity. People seem to somehow think that velocity is this magical number that's actually moving. I would argue that the velocity is just a function of them going and doing these quantitative easing. And the reality is that our desire to spend or create money has nothing to do with quantitative easing. And that velocity is not something we should be focusing on. And we should realize that the central banks that the commercial banks are not reserve constrained. And that is not what's driving private sector credit creation, which brings me back to the central bank and back to Powell. He rightfully understands that all he can do is facilitate the government's spending. He can't actually create any sort of stimulus. And I always worry whenever I hear people talking about, forward guidance, we can make stimulus through this way, or we can do this, cockamamie idea and stuff like that. Anytime someone tries to start telling me that they can make the central bank through monetary policy, make actual economic stimulus, I say those people don't understand it. Not only that, they're probably going to make the situation worse.
Yeah, it goes back to our good buddy Jeff Snyder. What he always says: the central banks aren't central.
Right.
And
people seem to think that they're so omnipotent, and the reality was they were for a while, because they controlled the rate upon which the private sector could create money. But that was when there was a desire for the private sector to create money. Nowadays, when you lower rates, it just doesn't make any difference. And quantitative easing never created inflation in the traditional sense. It created asset inflation, and that's again something where I disagree with my MMT pals. They argue that it doesn't. I think it does. But the reality is that the central banks at this point are basically impotent and cannot create inflation. And the quicker we realize that and stop expecting them to do it, the better off we're going to all be.
Yeah, it's all about the government, the fiscal side. So with your framework that we've discussed and you've articulated extremely well, what should we look for? What are you looking for in the next for the rest of the year, especially going into what is most likely going to be a crazy election.
Right. So one of the things is that I have been more constructive on equities. I hate bonds. I think that those are a disaster. But the thing is, I'm still a trader at heart. And so I still have times where I think, oh, okay, we can get a trade here. And so I have to be careful that I don't mix time frames. And if we're thinking about for a long time frame, I think that one of the things that investors should be very wary of is the fact that they've traditionally gone in the 60-40 portfolio as being a kind of a perfect environment in terms of bonds were negatively correlated to stocks and we have risk parity and all these, like, it's just a wonderful, kind of symbiotic relationship. I think if we go into a period where inflation picks up, that relationship between bonds and stocks will go from being, negatively correlated to positively correlated. If you go look at the 60s and 70s, that's the case. The ballast that what usually is bonds will now all of a sudden become an anchor on your portfolio. So I really believe that people should think long and hard about how they set up their portfolios. And I think that they should go look at things like gold and tips and other things that might benefit from inflation. Okay. Now, having said that, if we got into a situation where Biden comes and one of the things that everyone thinks that Biden is going to be the spendthrift president and is going to go and do all these policies, I worry that actually, before COVID, he was actually talking about raising taxes and doing all sorts of crazy things like that. And if we get a situation where it ends up being very acrimonious and they can't pass legislation, and it ends up being really difficult to decide what the fiscal is going to look like. And this is one of the things that I think is really, really important and never been more important. Martin Zweig, which was a very famous strategist that passed away a while back, but he was on Wall Street Break and he coined the phrase, "Don't fight the Fed."
Right.
I think that the new phrase should be, "Don't fight the fiscal." And so when you're trying to look at it from a shorter term perspective, the fiscal means everything. And for example, like Europe has been, sucking wind, let's just face it, from a, portfolio perspective on the equities. And although they're talking about fiscal, they're just talking about it. They're not actually doing it. And that's one of the things that I think when investors, I would tell them is watch for the countries that are spending. Yeah. And then the next thing that you need to watch for is, and I don't know how to articulate this, and it's very difficult, but there's one thing to kind of fix demand through just giving people money to spend. And there's another thing between investing, right? Like think about your company. If I gave you $1 million loan or $1 million and you went and just spent it on like the greatest party you've ever seen, you got the Killers to come play, it was free booze and everything. It was like, like $1 million, yeah, that would be stimulative over the short run, but it would be much different than if you spent $1 million, hiring some different people, buying new computers, making yourself more productive. And one of the things that I worry about is that in this haste to just go spend, economies that we just throw money out the window, it will not be as well off. Right. So one of my themes is going to be to start watching for the economies that are stimulating in a smart way as opposed to just stimulating. And,
right.
and
so
that
what
is
economies are those that you see doing that, Kevin?
Well, I don't know yet, but it's one of the things when I stare at, like, in Canada here, we've been doing some different things, and we're toying with the idea of a UBI, which is a universal basic income. And even though the MMTers love it, I'm probably more left-wing leaning than most Americans. But having said that, I still kind of cringe a little bit at the idea of a UBI. I would much rather try to figure out a way to do a job guarantee or something like that. And I worry that we're entering into this period where we're just throwing money out the window, and eventually that will just accelerate the kind of quickness to inflation. First of all, when you go and just throw money out, it's not going to go into productive things, and it's not going to make yourself any more kind of productive. Right. And so I don't have the answers for you in terms of like, this is the country you should go buy and they're doing smarter things. Having said that, if I was probably going to pick something, like I think you should be looking at Japan. I think you should be looking at countries that are doing stimulus in a smart way, that are investing. And I think actually Japan is one of those kind of quiet sleeper places to put your money.
Okay. You know what's interesting? Well, two things here. Number one, I want to mention to the viewers and the listeners that as a thought experiment, and I'd like to get your ideas on this. If let's just say the government spent a quadrillion dollars over the next 6 months, some just insane amount of money, if we could create the same, the economy could create the same amount of goods and services, then you wouldn't get inflation. You just have this big economic boom. So it's not necessarily all about the money creation. It's really, people have to get fixated on the amount of goods and services that are actually being produced. And I want to put words in your mouth, but I would assume that's why you favor more of a job guarantee program than
That's
just
you're
straight UBI.
Right, you're absolutely correct, and I think that's the pushback a lot of MMTers will have about when people get upset and worried about this inflation, they'll go, no, but the economy is going to be a lot more productive, and that is kind of what you'll hear from them, and I do think that they're somewhat correct, but again, like in most things in life, it's not like you're just going to throw money in the economy and there's going to be no bottlenecks and there's going to be and that they're not going to overdo it. They're going to overdo it. It's going to make inflation. And not only that, we haven't touched on this, but let's face it, there's a lot of private debt out there. What would be better in terms of getting rid of that private debt than having kind of a decade of 5% inflation? And you might say, well, that's immoral. And yeah, that's fine. Maybe it is immoral. I'm not going to be here to kind of pass judgments, but I will tell you that 5% for a decade really cuts that, debt burden down. And not only that, if you think about it from a kind of demographic point of view, which is one of the things that I think is actually most interesting, is that we're going to have increasing fights between the boomers and the millennials. Because the millennials are sitting there going and saying, look, I can't afford a house. I can't, my job stinks. I don't have any money. Now there's this COVID, and the boomers have all these assets, and they're going to go, well, we've got all this money. And the millennials, as they become more empowered and as they kind of take the reins of government, they're going to realize that inflation hurts the boomers a lot more than it hurts them. If you think about a young person, their biggest asset is their life of kind of working, which is ahead of them, right? So to them, like, inflation is not something that's going to really be a problem. Like they need inflation, and they're going to basically, it'll be a way to do intergenerational transfer of wealth. And
yeah, see, my hesitation there is, if you could just wave the magic wand and say, bam, we get 5% inflation for the next decade. But my concern there is, I don't know that it's exactly like a thermometer, that you just dial it and set it and then forget it. If it goes to 5, then it goes to 7. Now we've created this economy that can't stand higher interest rates, and then it just gets out of control. The genie gets out of the bottle, and then what do you do? But I think that goes back to your investment theme, doesn't it?
Well, for sure, I completely agree that it's not going to be 5 for a decade. It's going to be 5 over the decade on average, and there'll be spikes to 7 and then moves back to 3, and then it'll be like that. One of the trades that I have is, putting on my trader hat, is that I love the steepener trade, meaning like buying the short end of the yield curve and being short the long end of the yield curve, expecting the rate at the short end to stay low and then the long end to go up. And one of the reasons that I believe that is because I sympathize with the idea that the Federal Reserve can't raise rates because there's too much debt on the private sector side. And yet when you're sitting there and I look at it and say, okay, if we are having 5% inflation, maybe the government leaves rates at like the front end at 1, let's say they leave it at 1. What's the long bond going to be? Like, do you really want to buy the long bond at 2 when, if we have 5% inflation, that'll mean negative 300 basis points of real loss. So I really believe from a trading perspective that that's one of the great trades out there. I've been saying for a while that I think before this is all through, we're going to have record wides in the yield curve, meaning the difference between the front end and the short end is record wides. Now, the only thing is there is a chance that the government pegs the yield curve before this happens.
The Fed,
but
yes,
I think,
by the long end, yeah.
Yeah. But I do think that this is the way that we're headed. And I think that's one of the kind of most attractive trades out there. And I love that. I have that on right now. I'm long 5s against short 30s. I think that we're going to head a lot wider.
Okay, got it. So then I know we're running short on time here. One thing I just wanted to mention about Japan, I've talked to a few people about Japan, and what's interesting is if they could just, and I know they can't do this, but if they could just somehow magically get their debt to GDP down to like 100%, fundamentally they'd be a great economy.
Okay, so George, you know what? I actually love to talk to you about this because, okay, the Japan government has what, 250% debt to GDP outstanding, right? 250. The thing about it is, who owns 125% of that? The Bank of Japan.
Yeah, right.
Okay, so now I have a question for you, and I always pose this when I'm talking about kind of the plumbing of the financial system. If overnight the Bank of Japan ripped up those bonds that they own from the government of Japan, do you think anything would change in their economy?
Yeah, well, they wouldn't even have to rip it out. They just hit delete because it's just an asset on their balance sheet and a liability on the government's balance sheet.
That's right, and they're both government entities, right? They're both government entities, so it's basically a long and short.
So debt jubilee type thing.
Yeah, but you don't even need a jubilee because that implies that you're going to do it for everyone else. You could just do it for the amount that the Bank of Japan owns. Yeah. So now all of a sudden, what is the debt to GDP of Japan?
Goes down to 125%, right?
It goes from 250 down to 125%, which is back to my whole argument that governments are never financially constrained like we think they are. So if they can go do that, why are they stopping at 250? Because they can just buy, and you're going to go, well, that's going to create inflation. Yes, it will eventually create inflation. But as we saw that it doesn't create inflation until there's actual, that money escapes the banking system. So I think Japan is a very, very interesting situation because I think that a lot of people, there's a lot of famous hedge funds that have talked about this this hyperinflation that they're going to get because of their big balance sheet. And I go, well, that balance sheet isn't actually what everyone thinks it is, and it's not nearly as bad. And if you go look, what's really interesting is if you go look at the U.S. Kind of stock market and compare it to all the stock markets throughout the world, right? And you look over the last decade, obviously the U.S. has been one of the best, or has been the best performing stock market. But shocking to a lot of people is that Japan has been number 2, and it's by a long shot. Like I think it's way better than anyone else out of the majors. And then what they'll then say is, but wait, that's because the yen's gone down so much. But even when you adjust it into U.S. dollars, the Japanese stock market is actually still the number 2 stock market for Americans to own. I really think Japan is a quiet, kind of interesting thing that you should buy, and it's dirt cheap. Nobody likes it, and just kind of efficiently going about doing their things. I think it's something that everyone should go and have a look at.
Yeah, I was just going to say, it goes back to my philosophy. You just buy things when they're cheap and sell them when they're expensive. You don't win every time, but if you continue to do that over the long run, you're most likely going to come out ahead. I would lean more on the Lacey Hunt camp, or in that direction, with Japan just taking their debt from 250 down to 125% because the central bank owns those JGBs. But that's a completely separate podcast here. Before I let you go right now, Kevin, I'm sure what everyone is dying to know is just to get your kind of predictions for maybe the next. And since you are a trader, I think it's a unique opportunity for us to kind of get inside your. I talk to are just very long-term investors.
Right.
So for the 2020, what do you see with equities, bonds? We've talked about that briefly, but then the dollar, gold, and Bitcoin.
So I'm the worst Bitcoin guy. So I'm a skeptic, and someday I'll tell you the story. But I was an early adopter, and we mined and we actually arbitraged them. So it's not that I'm not a no coiner because I don't know what I'm doing. I'm just a no coiner because I don't like the thing. So I'm not the right guy. Gold, I think, is going to be a lot higher. Equities, if I had to, gun to my head, I think they go higher as well. U.S. dollar, I think there's too many people that are expecting this U.S. dollar rally to resume. They saw after the COVID and they got caught surprise. To me, I think in terms of when you're thinking about U.S. dollar, and people always say, well, who's going to sell it? Why are you going to go buy Europe? Why are you going to go buy all these other things? And I argue that the U.S. dollar and the U.S. financial assets have been one of the most overowned assets over the past decade that has ever been. If you think about it, if you're a European pension plan manager, you can't own European stocks. They've stunk, right? Like you've had to buy. The only place to be is America. So by doing so, and by having, until the COVID, U.S. was one of the few countries with positive real rates. And so it attracted a lot of capital. And I would say that the long-term money is well overweight U.S. And although this is started, I think it's going to be a long, multi-year process. And all we have to do is have people go back down to benchmark, and that will cause the U.S. dollar to keep falling. Okay. So I'm probably a big U.S. dollar bear, not because I think you're gonna lose the reserve currency status, or not because of the other kind of end of the world kind of scenarios. I just think that it's overowned, and it's that the world is changing, and that now all of a sudden we're going to see people going back to a more benchmark, and that will result in the U.S. dollar going down a lot. So we did dollar, we did gold, we did we have to do bonds. So bonds, I think, are a disaster. Although having said that, I think that over the short end of the curve, meaning like the 1 to 5 year range, it's not going anywhere for a long time. The Federal Reserve's on hold. I was joking the other day that if you looked at some of those charts, they looked like if it was a patient, they would have called them into the morgue by now, because there's no pulse at all. It's just a boring asset. But having said that, be careful in the long end. I think you could be surprised if we get a situation where the curve steepens and all of a sudden people start to realize that they have losses in this. And it doesn't even need the economy doing that well. It's just the realization that if more people start to kind of come around to my point of view that inflation is the big worry over the next decade, then I could see a situation where the long end really gets hurt. And so I think the bond market is something to avoid. And if you have to own bonds, I think you own tips. I still think that the tips are cheap, and that eventually you'll see a situation where those pension plans are reaching for them. There's something called inflation break-evens, which is the difference between nominal bonds and tips, which includes inflation. And the difference between those two is still trading at levels that are below the Fed's target, meaning that the bond market doesn't think the Fed's going to achieve their target, which is amazing because we haven't talked about it. But with the Fed going to average inflation targeting and doing fiscal, I think that it's never been more likely that we're going to see a situation where the Fed achieves their target, and it's going to be one of those things. Be careful what you ask for; you might just get it good and hard.
Yeah, exactly. Okay, then lastly, one thing I forgot is commodities. That's something that I really like because I just think they're really cheap right now. What are your thoughts on commodities? And I'll let you go.
So I love commodities. I especially love things that are related to the electrification of the world. I think that we're going to see a situation. Oh yeah, so copper is my number one. I just love copper. I'm trying to buy it and forget about it, George. Like I'm just trying to buy enough, and just kind of, because too often as a trader you start trading every squiggle, and then you wake up and you go, oh God, I was waiting for this little dip, and so I'm really trying to make it such that I'm long and I let it cook and stuff, because I think you're going to wake up and a while from now, and you're going to find that this copper is much higher. Although I'm a kind of a skeptic in terms of the valuation of these electric vehicle companies, there's no doubt an amazing amount of money is being thrown at them, and we're going to see a situation where this is going to progress a lot faster. I wrote this piece. It was called the picks, electrical picks and shovels, meaning that a lot of times when you have like a great California gold rush, the people that made the most money were not the people that were actually panning for gold. It was the people selling the picks and shovels. And in that vein, I kind of feel like instead of going out and trying to buy the next Tesla, I think I would much rather go out and buy the companies that are supplying the needed materials for the next Tesla. I saw this great study that went through how much copper, how much nickel we're going to need if these targets that we have are in place. There's something like in the UK by 2030, they want to have no more fossil fuel cars. Yeah. And if that occurs,
yeah,
it's something like I can't remember all the numbers. Like there's going to be 100%. They're going to need 100% of the world's cobalt, and they're going to need an extra 50% of the world's copper. And this is just the UK. Like the whole world's doing this. So I really think that there's a great opportunity there. The one last thing I'll leave you with in terms of thinking about it, if you go through history and you look at Japan and Korea as they became more prosperous, and you looked at their energy use as their society, it does a hockey stick. It kind of goes and it ticks up, and then it all of a sudden hits this point where they become prosperous enough and it explodes higher. Japan did it after World War II. Korea did it later. I think it was in the 60s and 70s. I have a feeling that we're just at the inflection point of the Chinese curve, and that we're going to start to see a greater demand out of Chinese energy demand. And I think that'll include, believe it or not, even the fossil fuel energies. And I know they're not popular. Everyone's telling me it's too early and that you shouldn't buy energy. It kind of feels to me like they're going to be the tobacco stocks of this generation, like that nobody wants to own, yet they ended up being a terrific play. And so I've been kind of picking away at some quality energy names even down here. I've been kind of going through. Be careful, because you got to make sure you don't end up with something that's not going to be around. Like, you don't want to buy probably some shale names, but the other kind of, there's some great names out there that are trading dirt cheap. And in your kind of philosophy of buying stuff when no one else wants to, I think that energy is something to look at.
Yeah, for sure. All right, Kevin, for my viewers and listeners who want to find out more about what you do, where should they go?
Well, George, it's been great being with you today. I really appreciate the opportunity to speak. So if they want to go check out my site, it's themacrotourist.substack.com. And if you want to see some letters, just send me an email, kevin@themacrotourist.com. I'll be happy to shoot you off some examples.
All right, Kevin. Thanks for a great conversation. I can't wait to do it again.
Thanks a lot for having me on, George.